This will be the first recording of our comprehensive question and a walkthrough of it. So on the left-hand side of the screen here, you can see that I've pulled up our comprehensive question from Chapter 4. I'm going to read through it, highlight the different sections, and as it pertains to the different schedules you'd be expected to produce. In future lectures, I will be going through each Excel schedule and showing you how all the numbers are connected. But first, let's talk about the question. PC Sales Limited retails a laser printer that sells for $250, and then they give you the rundown of the actual sales for last year's in units and the projected sales for this year in units. What they're really trying to give you is really a sales forecast. So on our Excel spreadsheet, let's just jot it down as to what we need to be doing here. We would want to be recording a sales forecast. They give us the months of November, so let's just do, November, December, and so forth. So from that you can, there we are, hover over it and drag across to March. Remember that in a sales forecast, we're looking for the sales in units for each month, as well as the sales in dollars. So for here, underneath, I would write something like sales in units, maybe the selling price, because that will really help us in determining the sales in dollars. Next section we have on is a directive of 40% of the sales revenue is collected in the month of sale, 50% is collected in the next month, and the remaining 10% is collected in the month after the sale. So what do you think this is asking us for? Well, our cash receipts schedule. So now we have the setup for our cash receipts schedule. What we are expected to do from this is really determine how much money we're getting in based on the sales that we're projecting. If there's any other cash inflows we need to factor in. And lastly, what's our AR position? Some of the items we would want to capture is, once again, we have our number or our months at the top here, so I would just copy and paste that down. Then we have our projected sales. There we are. Current month, because remember, we have a few different months when we're actually going to be receiving our payments. So current, next month, and in 2 months' time. As I've pre-read the question, I'm just going to leave this blank for now because we do have another factor that we want to include there, and it will be total receipts. Underneath this schedule, we want to figure out our AR. Probably at the end of a certain period. We'll see what the question asks. Next section over here is they tell us how the units are being purchased and at what volume. So, or at price. Total units are purchased at 150 each. PC's policy is to maintain ending inventory equal to 60% of the next month's sales. Inventory purchases are paid for in the month after the receipt of the goods. So what are we expected to do? Really, it's a purchase schedule. So let's record that we need to be working on a purchase schedule. So to arrive at that purchase schedule, we will once again need to copy down our number of months. And we start with the sales in units. We want to add in our desired ending inventory. Oops, and it doesn't like that, so I'm just going to change that quickly. We want to deduct our beginning inventory. That will give us our total purchases. And we will need to factor in some of the cash payments in order to calculate our ending in AP. So let's just do cash payments, a space down, and then our AP, which we can calculate later. Hopping back to the question, all expenses are paid for in the month in which they occur. Selling and administrative are average 10% of sales. Wages are $85,000 per month. Rent is $9,000. Amortization will be $2,500 starting in 2009. And the firm has a tax rate of 25%, and we also know now that they pay monthly installments of $25,000. All of this information we will need for our cash budget. We're probably not quite ready to do that yet because we also need to do our payment schedule. So there we are. So payment schedule. And we will want to include a few things. The payment for our purchases, which we will drag from above. Selling and admin, wages, rent, tax installments, some office modernization, which we will read later down the question, interest, which we also will read about later on, dividends, and then there's short-term interest. So the first one will be long-term, the second one will be short-term. We'll just change that to long-term. After that, we will work on our cash budget. So I'll just change this to cash budget. So we have our cash receipts, less our cash payments, will give us our net cash flow. We want to add the beginning, take into consideration now our projected cash balance, any loans or repayments, giving us our ending cash figure, and of course we have a cumulative loan balance at the very bottom here. There it is. So you can see how quickly we've sort of set up a general overview of what we need to produce. Let's go back to the question. Office modernization is planned for the first month of the next year, costing $100,000, which will be paid in early January, which I've sort of captured right in here. To help offset this payment, a long-term loan of $80,000 has been arranged. Proceeds will be received at the beginning of January. Payment on the loan principal will not start until July of 2009, but monthly interest payments at a rate of 6% per annum on the outstanding balance will be paid starting at the end of January. We also get additional information now in here that dividend, we'll just undo that, of $40,000 will be paid in January. Continuing on, PC's arrangement with the bank calls for a minimum of $6,000 all time. So that will really help us when we're doing our cash budget over here. So remember, our ending cash cannot be below $6,000. If it does, we have that short-term loan with interest of 9%, which is really high, by the way. And of course, interest on the short-term loan is calculated monthly and paid in the following month. So that tells us when we are doing our schedule, we need to watch our timing. Any surplus of cash is going to go and reduce that loan. So this is similar to what we saw in our master budget. Then they give us a balance sheet. This is sort of hinting that we'll need to do an ending balance sheet along with a statement of retained earnings. So at this point, we are ready to start typing in our figures. I will start that on the following lecture, but in the meantime, this is how we're looking. Up here, it's giving us our sales forecast information. This paragraph is pertaining to cash receipts. This paragraph goes towards our purchase schedule. Up in here, we're looking at our cash budget, which will eventually sort of flow through to our income statement and balance sheet. Same applies to here, more information that will help us with our cash budget and also our income statement. This is going to be really critical for us to do our statement of retained earnings, and of course we need to know some of the other figures to calculate a final or a pro forma balance sheet. And then the directives. Sometimes you may on the exam want to see what your directives are rather than going through all the steps because, hey, at the end, maybe you don't even need to do a statement of retained earnings, and so you don't want to do that legwork ahead of time. This will continue on the next lecture.